Okay, we'll get started here in a minute. Looks like we have people still coming in. All right, I think we'll go ahead and get started. I think this is a popular topic right now, but yet we know that folks are trying to get harvest done. So our CAP webinars are recorded, and so folks can go back and take a look at them if they've missed something today. So anyway, but I want to welcome everyone. Thanks again for taking time to participate with the CAP webinar this week. And I'm Glennis McClure, and I'm with the Nebraska Extension and a member of the Center for Ag Profitability at the University of Nebraska-Lincoln. Find out more about the center as well as an update schedule of more webinars on our website at cap.unl.edu. I'll remind you that we have Ag Money Smart Week coming up. I believe it's next week, and I know I'll be on a couple times talking about cost of production, as well as many of my colleagues in CAP will be offering some webinars and some other activities. But as the end of the year approaches now, we're glad to present another webinar on tax preparation for farmers and ranchers. And there's certainly plenty to cover again this year. We're glad to be joined again by Tina Barrett, Director of Nebraska Farm Business Incorporated. She will share key tax updates and strategies to help farmers and ranchers prepare for their end of year. Those will include impacts of the One Big Beautiful Bill Act, or sometimes we fondly refer to it now as OB3, as some might say. And I believe we'll hear about timely planning opportunities and review of deferring income from livestock sales as an example. As Director of Nebraska Farm Business Incorporated, Tina works with hundreds of producers in the state to provide financial analysis, business planning, and tax prep services. She began her career there after graduating from UNL with a degree in ag economics and served as executive director and has served since 2002. Tina is also a part-time instructor in UNL's Department of Agricultural Economics, teaching farm accounting, analysis, and tax management to undergraduates. We invite any questions you may have to be submitted through the Q&A panel in your Zoom window. Tina, thanks for joining us, and I'll go ahead and turn it over to you.
Sounds good. Thank you. All right, well, let's get started. I've got I know I have probably more than we can talk about today, but try to get the important stuff up front. We'll do as much as we can, and I've got the slides, or Ryan's got the slides that he can post. So if we get to the end of things, you can kind of see what I had there. So lots to talk about, but let me start just to make sure, again, Nebraska Farm Business is an accounting firm here in Nebraska. We started as part of cooperative extension, really with the goals of using financial analysis to help farmers and ranchers. But we also do the tax side of things. And so I just wanted to make sure that everybody knew kind of what we do and why I'm talking about this. So like I say, we're going to talk a little bit about some of the new tax laws, talk a little bit about the livestock and crop deferral issues, just because we still have the ongoing drought in a lot of the state. And then a little bit maybe on some general things towards the end. But couple, just the big things that came out of, I call it OBA. So I've definitely heard the OB3. I also have heard it ABA, so that just makes me want to sing Mamma Mia. So I don't like that one. So yeah, OBA was usually how I get rid of the mouthful of the One Big Beautiful Bill. But what it did was a lot of extensions, a lot of different things. And so the important parts of this is to figure out what's going to impact 25 and what's going to impact future years. But what we've got, the first thing was an increase in the standard deduction. So if you remember, the Tax Cuts and Jobs Act back in 2018 took us from the standard deduction limits that would have been similar to what's in that final column, that 26 projected pre-OBA levels, they doubled those amounts. And so we were looking at a $15,000 single, 30,000 married filing joint for 25. But in the bill, they went ahead and increased that just a little bit, and up to 15,750 and 31,500. They made this increase permanent, so we won't go back to that half level anytime automatically, and it will index for inflation, so it'll go up just a little bit. Some of us preparers think that they must just not have liked having round numbers and said, forget that, we got to get some extra digits in there, because we don't very often get nice round numbers like 15 and 30. So, but we got a little bit more out of it. So, all right. The personal exemptions, again, were something that was put on hold with the Tax Cuts and Jobs Act. And that was part of the reason why the standard deduction went up so much, is because they took the personal exemptions away. And so what OBA did was just permanently repeal those, because those were set to come back next year. So I think we're probably done with personal exemptions. Always probably good at this point to say, when I say permanent, all I'm meaning is that until Congress changes their mind again. Like what the Tax Cuts and Jobs Act did was put in a lot of these things with a sunset at the end of 25. And so these provisions now don't have that sunset. So it won't change unless Congress does something. And so that's when we say permanent, that's what we mean. It just means until they change it. But at this point, at least there isn't an automatic removal of that. One thing that they did add that is new is this deduction for seniors. And there's a lot of, I think, misconceptions about this one, because it's kind of billed as no tax on Social Security, but it really has nothing to do with Social Security, other than you have to be 65 years old to qualify for this. So that's really the only qualification, other than the income phase out, which we'll talk out here. But if you're over the age of 65, you're going to get a extra $6,000 deduction. It's per person. So if both spouses are over 65, it's going to be a $12,000 deduction. And you don't even have to receive Social Security. All you have to do is be over that age and then be under those phase out limits. So again, that's if your income is less than 75,000 single, or less than 150,000 married filing joint. So that's going to, kind of put some limits on things, but if you're in those income levels, that's going to make a big deal or difference. And it's also just important to point out that this doesn't require you to itemize or take the standard deduction. Either way, however you choose on that part, this is going to come in regardless. So the only thing that they did put in here is that you have to have a valid Social Security number in order to take this. You're going to see that throughout a lot of these changes, is they put that requirement in that you do have to have a valid Social Security number, or they will disallow it. So it's actually probably an important point when you get that tax return back, to make sure that your Social Security number matches, because even if you accidentally put the wrong Social Security number, it's going to disqualify you for a lot of the features of this bill. So when we e-file a return, we can't actually get it submitted unless the name and the Social Security number match. So, if you're using a preparer, that's probably not a big deal. But if you would be doing a return on your own or through a different service, you want to make sure that those are okay. So this one is also only good for 25 through 28. So this is one that is set to expire. Again, just was an expensive bill, so that's how they, or expensive provision, so that's how they sneak that in there, is just to do it for a short amount of time. I did put together just a couple examples of what this could mean for seniors. So I went with like an $80,000 total income, so that would be like 50,000 gross Social Security plus 30,000 of other income. So at that level, you're only 15,000 of your Social Security is taxable. So you don't pay tax on 100% of your Social Security ever. The most you have to pay is 85%. But there's a range in there that as your income goes down, the percentage of your Social Security goes down. So at that 80,000 level, if it was 50,000 of Social Security, you'd get the regular standard deduction of 31,500 plus 1,600 for each individual over 65. That's a regular standard deduction. That just helps the that's been in the law for a long time. Then we get the additional 12,000 senior deduction. So on that $80,000 of income, if you're both over the age of 65, you wouldn't actually pay any income tax to the federal government. And so that's kind of as a nice little it's a significant impact. How about that? If your income, then your other income was up another 20,000, that starts to kick in pretty fast because that Social Security ramps up and you pay more of that as your income goes up. So with 100,000 of income, you'd pay about 3,800, so a 3.8% tax, still very cheap, not bad at all. And then again, at 120 is where that Social Security max would hit, where you'd be paying 85% of that. And the tax would be about 7,400 or about 6.2%. So still significant, just not quite as big of a deal as maybe they were either hoping or what we ended up getting out. All right, so next thing was the child tax credit that got tweaked a little bit. We were at a $2,000 per child under the age of 17 limit, and it was going to go back to, I think, $1,000 in 26. So they went ahead and made this permanent as well and indexed it for inflation. So that 2,200 will go up annually as we go forward. And then if your income is low enough, there is a refundable portion of that, of the 2,200, 1,700 of it is eligible to be refunded to you. That is also going to be indexed for inflation. And then the Tax Cuts and Jobs Act had raised the income limits for married filing joint from somewhere around 100, 110,000 up to 400, and that was also extended on a permanent basis. So a nice feature for if you've got kids under the age of 17. Mine have now all timed out, and I have no more in that age group, but I do have some in this group. So this was again new in the Tax Cuts and Jobs Act, but this is for a $500 non-refundable credit for dependents that don't qualify for the child tax credit. So anybody that's over the age of 17 or older, and or if your parents or your dependents, those kinds of things, you get a $500 credit. Again, made permanent and both of these were permanent with OBA, and both of them put the requirement that the child and at least one parent have to have a valid Social Security number. We've had the child requirement for a while, but now they're requiring at least one parent to also have a valid Social Security number in order to qualify for either one of these credits. All right, a few of these business things. So the qualified business income deduction 199A was put into place again with the Tax Cuts and Jobs Act and was set to expire. This was going to be the last year. OBA went ahead and made this one permanent as well. So we're stuck with this. This is a good thing. I mean, this would have been very expensive or very impactful for farmers and the amount of increased income tax this would have caused. So this is a good deal. This is for anybody that's a qualified business, which is pretty much sole proprietor. So if you file a Schedule F, or you have a pass-through entity like a partnership or an S corp, then you're going to qualify for this business income as long as your income qualifies. But this does not work for C corporations. They didn't make any change there because the whole idea behind this deduction was to equalize the 21% flat rate that they gave corporations permanently with the Tax Cuts and Jobs Act. And so this is kind of the trade-off for that. They get the 21% flat rate, and everybody else gets this qualified business income deduction. The one thing that they did change is the phase out range, but it's not starting until next year. Okay, so if your income is too high, then they take that 20% away. And then there's some other qualifications that make things complicated, but we had a $100,000 phase out range. So when your income was about 350 for married filing joint up to 450, then it started to phase out how much of this you could get. And so they've stretched that to 150. So it'll still kick in about that 100 or 350-ish range and go up to 500. And those numbers are indexed for inflation. So it's not exactly 350. It kind of keeps rolling. But that does help some of those higher income that were being limited, especially if they didn't pay any W-2 wages and didn't have a lot of investment, which are ways we can get around that phase out. So, okay. The other thing they added, which will start next year as well, is a new minimum deduction. This one makes no sense to anybody, so I don't know who was thinking that it was worth the paper that this is going to take to define rules. But they put in a $400 minimum deduction. So you have to have at least $1,000 of QBI, and you have to materially participate, which is not shocking because most of the qualified businesses would have that. But $1,000 of QBI already gets you $200 of qualified business income deduction. So, and by the time you get to 2,000, you would have gotten the 400. So it's really only going to impact those with net incomes between 1,000 and 2,000, and it's going to give them a little bit of a deduction. But regardless, we have a new little minimum starting next year, and we'll see what they do with this one. But all right, one of the big ones, again, we had, prior to the Tax Cuts and Jobs Act, we'd gotten a $5 million estate tax exemption. So again, the exemption is how much you can pass through on your estate tax-free to your heirs. So no estate taxes on that amount. We had gotten a $5 million permanent and thought that that was a pretty great deal. And then the Tax Cuts and Jobs Act came around and said, no, we're going to double that to 10 million, index it for inflation through 25, and then it'll go back to the old rules. And so we've been watching that, thinking that starting next year, we'd be back in that 7 million range because that 5 has been indexing for inflation as we go along. What OBA did was said, forget that. We're just going to make this permanent and increase next year. We're going to start at 15 million next year and index that for inflation. So we're at 13.99 for the rest of 25. And then starting January 6th, that exemption will go to 15 million per person. And we'll continue to index there. So again, it's permanent until they change it, but this gives us a really nice dollar amount that that will help the majority of farms not even think about estate taxes as a concern right now. So because that's per person. So a married couple can pass on $30 million of net assets. So it's assets minus liabilities to get to that $15 million number. So it's quite a bit there. And then again, we could do some of our traditional tax plan or estate planning tricks and get probably somewhere in the middle of 40 to 50 million of net assets passed on pretty easy. So certainly gives us a lot more to work with. So that's a good one. All right. The provision that probably got the most press because there was a lot of holdouts on increasing the SALT limit. So again, SALT is just an acronym we use for the state and local tax deduction. So it's part of the itemized deductions that authorizes you to deduct your state income taxes. The Tax Cuts and Jobs Act used this as a way to pay for some of the provisions that were in there. And so especially the high income states really had a problem with this because we couldn't deduct our state income taxes again. So what they did was said, okay, starting in 25, the SALT limit's going to go up to 40,000. And that's going to stick there, indexing by 1% a year through 2029, and then in 2030 it goes back to 10,000. Okay, so that was one of the permanent features of the Tax Cuts and Jobs Act, and so that 10,000 is going to sit there kind of underneath. There, of course, are some limitations to that. So once your taxable income gets over 500,000, married, filing joint again, they're going to start to phase that out 30% of the amount over until you basically get to 600,000, and then the limit is 10,000 and it won't fall below that. So they gave us a higher exemption, but not for high income taxpayers. So in Nebraska with a 5% tax, it takes a lot of tax, a lot of income to get to a $10,000 state income tax. But this also includes the real estate taxes on your personal residence and a few other things like that that would help kick that in a little bit as well. So if your income's less than 500,000, then we've got the 40,000 to go. There was some talk and about changing the PTET. So we've talked about that a little bit in the past. I've got a little bit more information here for you we'll get to. But Congress was considering limiting that, or maybe not removing it, but at least limiting how much we could get, because that's the workaround that most states put in place to help their individuals get around this limitation, but they didn't change anything with that. So, all right. So that again was new in 23 for Nebraska. A lot of the states implemented that earlier, but it allows essentially pass-through entities, so our S corps and partnerships, to pay the state income tax for its owners, which as a business, they get to claim that as a federal deduction then. So that's how we've been working around this. And so then the partnership and S corp pass through a credit to your individual. And so, it kind of works itself in a circle, and the entities give the money to the state gives the money back to you, and we get a federal tax deduction out of it. So I'm not going to spend a whole lot of time on that, other than the question of, is it still worth doing this with the higher salt limit? Because that's probably going to be a question. And I really wanted to come up with a chart that would show exactly where it was beneficial, but there's just too many moving pieces. And so these are just, some of the things I kind of came up with that it's going to make a difference. But part of that being what your federal tax rate is, the lower income you are, the less we're saving. It might not be worth the hassle. If the pass-through income is subject to self-employment taxes, makes a difference. If it's eligible for the QBI, that qualified business income deduction, makes a difference. How much your other itemized deductions are, and really where your modified adjusted gross income is, so that are we going to be limited, or we can take that 40. So I ran through some examples just to kind of give you an idea. So this one is a $5,000 of state income tax and $100,000 of total income. That would get you a $5,000 deduction against your business income, which would save you about $600 because you'd be in the 12% bracket. If we had self-employment taxes on that income, that's going to save you another $765 by turning that deduction into a business deduction. But we would lose 20% of it as in our QBI. So that's actually going to add back 120. And then we take that standard deduction on there. And so in total, we're getting about a $5,000 benefit. If we didn't do the PTET, we wouldn't have, and we didn't have any other itemized deductions. We're still going to take the standard deduction. And so we would end up, about $1,300 or $1,200 worse off by not doing the PTET. It's not a huge dollar amount, but it is about 33%. So it's a significant deal there. So, all right, then let's look at a higher income. So 10,000 of state income taxes and 200,000 of income, that's going to put you into the 22% bracket. And so, again, we can walk through all the numbers, but at that higher level, now we're getting about a $2,000 savings for doing the PTET over using just the standard deduction, again, if that's your only itemized deduction. So this time I'm going to flip here, and I added 40,000 of other itemized deductions. So maybe it's charity, maybe it's medical expenses, whatever. But if we do that, then it's actually better off to not do the PTET, but it's only $150 difference. And so it's not a significant deal. And if you were going to bet on which way you're going to do it, the potential savings of if you didn't itemize otherwise was significantly bigger than this one. So also ran that again at a higher level. at that $500,000 mark where that phase out would begin. So we'd still be able to get that full 40,000 if we wanted to. But again, 25,000 of state and local taxes is not going to be enough to itemize or not better than our standard deduction. And so we really don't get any benefit there. So again, this time with the higher income, it's like almost it's a $7,000 difference in being able to do that PTET and not get any benefit out of that deduction because of the high standard deduction. So again, if at this level, if we have that other 40,000 of itemized deductions, then it's still again better to use the regular old method, but like not by much, still not $1,000 difference. So they're kind of a wash, but definitely seeing that benefit if you don't have those other itemized deductions. And then I did one more just at a real high income level, where that phase out would bring that itemized deduction back down to a $10,000 limit. And so significant savings at that higher income level, using the PTET because we're getting that deduction out of it. And then still a significant savings using PTET because we can't use all of that state and local tax, even if we had other itemized deductions. So the general rule is it really is going to be specific on your circumstances, and we need to take a look at that individually. But if your income's over the 600,000, it's going to be a no-brainer to keep using the PTET. And the higher your income is, probably that's still going to be the right answer. And it's certainly going to be the right answer if you don't have other itemized deductions. And we could use that high standard deduction and get the PTET. So, okay. So it's a kind of a big concept, but it's an important one for businesses that have those the opportunity to do the PTET that way. So, all right. One thing that we haven't talked about in a long time, because of that high standard deduction and low SALT limit, is doubling up itemized deductions as a tax planning strategy. But I think now that we have the $40,000 limit, we could maybe talk about this again. The one thing you want to be real careful about is to watch and make sure that your income isn't high enough that it would kick you into an alternative minimum tax liability situation. But again, that's going to be pretty specific on your case, but we'd want to watch that. So here, in my example, I just use, we've got $7,500 of state income taxes. You give $10,000 to your church or other charity and have $5,000 in real estate taxes. So you would have $22,500 of itemized deductions. It's less than the standard deduction. We're not going to use it. Okay. So I just put that in the chart. We'd have 2 years where we'd use that standard deduction and get about 63,000 over the 2 years. If instead we paid both years of state income tax in 1 year, so you pay one in April, pay and prepay the next one in December, double up those charitable contributions in the same calendar year. Do the same thing with your real estate taxes. You can pay the first ones in April and September, and then pay the next round in December. We could get that itemized deductions up in year one to 45,000, come back and use the standard deduction the next year and have a $76,000 deduction over the 2 years instead of the 63,000. So again, might work and be a tool that we can go back to using that we just haven't thought about much for a while. Another piece that kind of fits into this from a strategy plan is maybe using a donor advised fund. These have been a little bit more popular since the Tax Cuts and Jobs Act was put into place because of the way it's hard to itemize. What this allows you to do is to put a bunch of money into one of these donor advised funds and use that itemized deduction this year, and then dole that money out over several years like you would, so your charities don't see any difference. And anything in there grows tax free as long as, and it, just would end up going to charity in the end. And so it's kind of a nice little tool. We can use these also to put grain in there as a charitable donation, which eliminates your Schedule F income. So that gets you a little better deduction. And we never have to worry about getting to that itemized deduction level and just use the standard deduction. So again, just a tool that might be beneficial, especially if you have the higher income, you're using the PTET for your state income taxes and want to be able to support, some charities in a meaningful way. So, all right. One of the other things that got a lot of press was the deduction for qualified overtime and tips, right? I'm not going to spend a lot of time with tips just because it's really not applicable to farming. There's a list of businesses or industries that would be typical that you would receive tips. So it's not like you can all of a sudden start saying, I'm going to tip my employees for their wages for the year, because they put in some pretty good safeguards to make sure that stuff like that is not going to happen. So, that one's pretty much out. So let's talk about the overtime one. Again, this is a federal tax deduction. For qualified overtime, it's limited to $12,500 per person. So if you're married filing joint, you could take a $25,000 deduction. This is only good for 25 through 28, tips the same way. And it starts to phase out if your income gets above 150 for single or above 300 for married filing joint. Okay, so if your income's above that, probably not going to qualify. The way they defined overtime is they said that it's any pay that's required under the Fair Labor Standards Act. So for us in agriculture, we have the lovely exemption from that so that we're not required to pay overtime. So that means even if you do voluntarily pay your employees overtime, they do not get this deduction because they're not required under the Fair Labor Standards Act. So kind of a stinky deal. They are talking about changing. There's already talk about changes to that, and even discussion that maybe once IRS gets back to work and really gives us the rules for these, that they might even loosen that standard a little bit more to include some more people. But at this point, nobody on salary gets it, and nobody on that are an agricultural employer or employee. Also, it's only the premium amount that's allowed for the deduction. So that there's a lot of misconceptions on this one too. So if we have an employee making $20 an hour and their overtime rate is $30 an hour, we get to deduct the $10 an hour, just the extra, not the extra 20 that they're getting for more than 40 hours, but just the $10 of extra. So it takes a little while to add up on this one, but for those employees who have been working a lot of overtime, it could be an interesting or a significant help. Again, you've got to have a valid Social Security number on your tax return in order to qualify for this or the tips deduction. There is a little bit of a caveat that we should probably talk about in the Fair Labor Standards Act is they say like secondary agriculture is included in that. So the things that it's pretty much anything that's happening on a farm. So that's definitely exempt, but it doesn't exempt stuff that's outside of the scope of primary or secondary. So if you're packing and processing farm produce, or if we're if you're taking that a little bit different, a little bit outside of the actual farm operations, even 1 hour of that kind of work excludes you from the exemption, which would require you to pay overtime, but qualify you for the deduction. So really need to pay attention to that from many aspects, but one, making sure that we're paying the overtime if required, and then two, getting this deduction. So the law did say that it has to be separately reported on the W-2 or on the 1099 if it's not an employee, but IRS came out right away and said, we're not changing the 25 W-2. And so they've put some draft instructions in place that they're going to have a new letter in box 12 for that for 26. But in 25, they just say, do what you can, and any reasonable method is going to be accepted. So how you calculate it and how you report it they're kind of going to say, okay, whatever you need to do. So we're thinking put it in box 14 as a note so that your employer's preparer can get that handled correctly. But it sounds like they're going to be pretty encompassing with that one. So yeah. All right. Let's talk about the personal car loan interest. That's a new one too. And so, well, it feels brand new. There used to be deductions for this back, I think it was early 80s when they took that out, probably in 86. This isn't an itemized deduction. The car loan interest, the senior deduction, the tips, and the overtime are all on a new form. It's called Schedule 1A. And so don't have to itemize to get this deduction. Again, it's only a 3-year deduction that you can get this one, but it's any passenger vehicle less than 14,000 pounds. That's not too hard to get to. And it has to have at least 2 wheels. I don't know who was trying to exclude unicycles from this law, but as long as it's manufactured for the road and has 2 wheels, we're pretty good there. So the other thing that caveat they put in there is that final assembly has to happen in the United States. And so it's going to be really important to check that. It should be something that the dealers can check for you before you purchase a car. But even it's my understanding that like even a Chevy Silverado, you could get the exact same model with the same features, one of them finished in Canada and one of them finished in Indiana. And so, if this was important, we would want to check that beforehand. So to claim this, we've got to have the VIN number on to put on your return, and so that'll tell us when there's a website within IRS that we can put that VIN number in to say that it is in fact qualified. There's a few, it has to have been purchased in 25, and the loan has to be the first lien on that vehicle. You can deduct up to 10,000 of it. And remember that this is not an impact or doesn't impact the deductibility of your farm vehicle interest that we would take on Schedule F. This is only the personal loan interest that we would not be a business vehicle. So phase outs on this one as well kicks in at that 100,000 single married filing joint at 200. So again, if your income's over that, you can kind of forget this. It does sound like IRS is not going to require the banks to report this interest for 25. They will in 26. So we might have to do a little bit of work to dig up how much interest was actually paid in 25 to be able to claim this. So could be interesting. All right. One of the other new things that they put in here was the Trump accounts. And so these aren't Roth IRAs and they're not traditional IRAs. And in a lot of ways, they kind of have the worst of both. You don't get a deduction like you do with a traditional IRA, but when you take stuff out of it, it's all taxable like a regular IRA. And so it's kind of an interesting, contributions can be made before a child turns 18. Both a child and a parent have to have a valid Social Security number. But for children born between 2005 or 25 and 2028, if you don't set up one of these accounts, the government will, and they're going to put $1,000 in each of those for them. And so if nothing else, that money will sit there and grow for them and be kind of a savings. You have a limit of $5,000 a year that you can put into that. Pretty much anybody can contribute for you or for your child. In fact, your employer can put up to $2,500 of that $5,000 in there, and that is not taxable to the child or the parent and deductible to the employer. So there's one place where we could probably get a little benefit. Might be a planning point for some of if you're set up to where you're the employee of the business, that the business could potentially do this for your child. No contributions could be made before July 4th of 2026. It was 1 year after the law was enacted. So this gives us some time to figure this out. So it's just kind of something to have on the radar and things that we're thinking about. But it could be kind of interesting as these go. So once the you can put into these until the child turns 18, and you can't take out of them until the child turns 18. So once that happens, then they become very similar to a traditional IRA, where they can't take the money out without penalty until they're at over 59 and a half. So yeah, so I did just do a little bit of math. If we only just put the $1,000 in there, and it just grows at 7% until the child is 65, be somewhere around like an $80,000 that they have saved for retirement at that point, thanks to the government. If you would, or your employer would put in the 2,500 every year until they turn 18, then we're talking about that being somewhere in the $2 million range. And if you would do the full 5,000, then they would have, 4.5 million at the end when they went to retire. So again, kind of interesting. We still need, like I said, a lot of guidance on this one, but we've got time on it. So, all right, let's talk about depreciation real quick. The Tax Cuts and Jobs Act had bonus depreciation phasing out. And so we were looking at a 40% deduction this year, 20 next year, and then gone. So that's all gone. What OBA did was made it a permanent 100% bonus depreciation. And so we've never had bonus as a permanent law change before, or a law before. So this is kind of a new ground. It is for anything that was purchased after January 19th, 2025. Okay, so that's kind of an important date. Anything bought from January 1st to January 19th, it gets the 40%. Anything bought after that is going to default to the 100%, but we can elect a 40% if we want to. Okay. There is a weird little caveat in here that you should be aware of, and that's just the way the law was written, is that if you had a binding agreement, so if you had the contract made before the 20th of January, even though you didn't place it in service, you didn't have it, you didn't pay for it until after, they're still going to say 40%. You don't get it. It has to have been something that happened after January 20th. So just watch out for that one. Another thing that the Tax Cuts and Jobs Act did was limit the meals provided for the employer's convenience to 50%. And that was a 50% through 2025, and then was going to go to zero. And kind of thought maybe that they would change that, but this is one of the things they didn't change. Okay, so starting January 1st, it means that we have no deduction for any of those employer operated facilities or meals provided for the employer's convenience. So, we did that a lot with our C corporations, where we provided meals for employees, and no longer can do that. There was one little caveat, which I find interesting enough to talk about, that if you have a fishing boat or a fish processing facility above the 50th degree of latitude, then it's fully deductible. So I had ChatGPT draw me a picture, so I won't guarantee that this is accurate, but it looks like it is exactly right there at the top of the contiguous 48 states. It says that there's a little corner of a lake in Minnesota that's eligible, and Alaska. So certainly something that must have gotten put in there in order to get an Alaska vote, but that would be the only time that we can get those convenience meals deductible now. So 179 was just a little tweak. We already had it permanent. And so what they did was tweak that up a little bit higher. So it was going to be $1 million. Now it's at 1.25 million. And the investment limit was bumped up a little bit also to 3.13 limit or million. So just a little tweak there. Otherwise, that's still also permanently part of the law at those pretty high levels. So I'm sorry, those were what they were going to be. They bumped them to 2.5 and 4. I had that in my head wrong. So again, going to index them for inflation. Nothing too big there. There's some pretty minor things. They put in a little, this one starts in 26. Back in COVID, we had the ability to take a $300 charitable deduction, I think in 20, and then in 21, it was $600. And then it went away. So they brought that back, made it permanent. And so this is, you don't have to itemize, and we get a deduction for the first 1,000 for if you're single, 2,000 if you're married filing joint. We still have the same rules that we have to follow. But that one, as far as, documentation and all that kind of stuff, but it's kind of a nice little above the line deduction. Then if you do itemize your deductions, they put a little haircut in there. That's what they call it. So that we have that with medical expenses there. We have to have more than 7.5% of your adjusted gross income to qualify. Now we're the first 0.5% of your charitable donations is not going to qualify. And if you're a corporation, it's a 1% haircut. So just probably not a huge thing. And again, that's for next year. So it's not going to impact anything this year. All right. This is another kind of a weird one that they put in here, that it sounds probably better than it is. But what this allows you to do is if you're selling farmland, you can have that income or that tax paid in 4 equal payments over the next 4 years. It doesn't mean that we get to calculate the gain over the next 4 years. We calculate the gain all in the year of sale, but then you have 4 years to pay it. And so there you have to be a qualified person to do this. So you have to have farmed the property for the last 10 years or leased it to a qualified farmer for those 10 years. There has to be a covenant in that purchase that says that it will continue to be used for farming for 10 years. And that covenant has to be filed with the tax return. And so it's kind of an interesting little catch and probably a tough one to really pull on that. But again, any tax year after July 4th, 2025, so if a fiscal year corp would qualify. But again, the savings of this is not going to be in taxes. So I did a quick gain of 1.5 million on a piece of ground. That's going to be a $300,000 tax bill. So normally he'd have to pay that all in 26. If he spread it out, it'd be 75,000 a year for each of those 4 years. So really the benefit could be the time value of the money. So I just ran through investing that at 5% for those years. And it might end up with $25,000 worth of interest by spreading those payments out. They do have some pretty specific rules for if you miss one, then all of it becomes due immediately. And somebody passes away in that time, it's due immediately. So again, well, we have a little bit of time. Well, it's an interesting thing, but that covenant attached to the return and to the land sale is going to probably be the tougher part of this. But what they were trying to do is keep farm land in farming and keep it, getting it sold to farmers. So it's kind of an interesting rule, but it's kind of what it is. Okay, this one is again for 26, so don't get confused by this, but they've finally changed the $600 limit for sending or for issuing a 1099 to somebody for either miscellaneous income or non-employee comp, and they're upping that to $2,000 and indexing it for inflation. It has been $600 since the 1950s, so 600 is definitely different than it was back then. But beware, this is for payments made in 26 and later. So the 1099s that we need to file in January is still going to have that $600 limit. So one more year of 600, and then we can move into a $2,000 limit. So kind of nice as we go forward. All right, Glennis, we got some questions. Before I get into some of these other things that I think are probably, just more general topic things.
Well, I just see one in the Q&A right now, and this goes back to the PTET. Do we have to claim back the PTET refund as income in the year the individual receives it if they did not itemize deductions in the prior year?
Yeah. So that's a good question. How about that? The IRS has pretty much said no. Because the tax is paid by the entity and received by the credits received by the individual, it's not the same taxpayer getting that tax benefit. And so no, is the position that we have. It would be nice if we got a little bit more clear guidance from the IRS on that, but that is the general consensus, is that no, you do not have to take that as income the next year.
And I was just wondering a little bit about the Trump accounts, and I know that doesn't really, there's some time on that, as you
Yep.
said, because the rules aren't totally out yet, I guess, but, so let's say we put money in for our grandchildren, and when they turn 18, they can start using it for college, et cetera, right?
I don't think so. I think it follows the traditional IRA rules where
Oh,
it's there until
okay.
they turn 60.
So it's
So,
really separate from that, because
yep.
again, they're the ones that would be paying the tax. I mean, right,
Right.
so.
Yeah. So one suggestion would be that we convert those to a Roth right away, though. So we at least we think we would be able to take those, what would look like a traditional IRA, convert them to Roth IRAs, and then we would have some of those flexibility things, and it could grow tax free since the distributions are going to be taxable. And one thing that will be interesting is if we can roll those while they're still a dependent into a Roth IRA, so we can use their standard deductions when they wouldn't be
Right,
paying taxes anyway. So,
right,
so kind of interesting. Again, lots of things we're going to have to get some
yeah,
more clarification on, and so we'll definitely talk about it more next year. So,
yeah, it sounds like it.
okay.
Was there any other questions anybody had right now?
Yeah, a couple other things I forgot. I want to point out before we go too far is Trump did make a executive order back in March that said the federal government was not going to basically handle paper checks anymore. So they have, and they put a September 30th deadline on that. And they've pretty much, I think, got things processed to where they're anything coming from the government is being processed electronically. But they've kind of told everybody just hold tight, keep paying. You can still keep sending us checks for now, because they don't have all those systems figured out. So at this point, if you're going to get a refund on your tax return, you're going to have to put your bank account information on that and get that paid electronically, which works much better anyway. It takes a lot longer to get a paper check out of the IRS. But as you start thinking about paying taxes next year, you need to be paying attention to see if they've put these rules into place yet. And I know people like to write checks for their taxes, but this looks like it's coming. It's just a matter of when. And so if we get to where we have like the estimated taxes, and they put that requirement in June, just make sure that you're checking before you make that September estimate to see if they're going to accept that paper check. Um, so one of the things that they want to do again is just make sure that we've got that bank and routing and bank account information to your tax preparer. And then the other things that work out really, there's a IRS direct pay that works really well on their website, or you can log in and create an EFTPS account. If you've got a business, you probably already have one of those, but you might need one for your individual tax account. The other thing that you can do is set up an IRS account. Um, and those actually are really nice. They require a lot of security to get into. But once you get into that, um, then you can see your balance and your payment history. You can see when things were issued, when your tax return was processed. You can get digital notices so that you get that communication faster. You can give your tax preparer access to some of that information so that they can answer those questions better. So these IRS accounts are pretty great. Again, go to IRS's website and they'll walk you through that. You have to use that ID Me, which is a little bit cumbersome to pack up or to set up, but once you do that, then it's a really easy verification process. So might not be bad to get that set up. Then you can control those payments in the future. So, all right. I think those were the kind of the big things that I think were real important that we talk about. Um, there's certainly things, I've got some slides in there about prepays, making sure we don't break those rules of you not going too far over your normal purchases, making sure that it's an actual purchase. You need to have a receipt that shows you bought a specific quantity of fuel at a specific price. Don't go give the co-op a $25,000 deposit and call that a prepay. All right. So we want there to be an actual purchase, or IRS will disallow that. So pay attention to that one. No changes on the crop insurance deferrals, so I'm not going to spend really any time there. Just remember that anything that's due to price loss is not going to be eligible. It has to be destruction of crops. And so otherwise, then if you're a cash basis taxpayer and you have a practice of selling more than half your crop the following year, then you can go ahead and defer that regardless of when it comes. The livestock deferrals, again, not a change on those, but we do have the two options. One's a 1-year deferral, and then we've got that 4-year deferral. And I did want to pop up the slide that I have here. Again, sorry, I'm going to skip through some of these, got too much animation, but this is the map for 25 for the counties that were declared disaster areas. So this gives us the authority with those livestock deferrals. So if you're in a county that's red or yellow or orange, you'll be okay. So pretty much all of Nebraska, except for that extreme third or extreme eastern side, would be eligible for those deferrals. So, and I'm thinking that's, again, just some details. And again, you can get those slides. And if you've got questions, you can sure respond. Maybe one other point is think that changed in OBA that nobody's really, well, we're talking about it because this is one of the issues that's causing the discord between the government shutdown is the premium tax credit cliff is back in 26. So if you remember before COVID, really, we would have, if you went over 401% of the federal poverty level, you were immediately responsible for all of the health insurance claims. And so you could go from owing 2,000 to owing 25,000 with an extra $5 of income. And so that's back. We haven't had that for a while. For the last few years, you haven't had to pay any more than 8.5% of your income as health insurance. So as you're signing up, if you're on the exchange, be real careful with what income level you're putting in there and make sure it's an income level that we can hit next year because you could be jumping off that cliff. And I had to put in a picture. Those are cliffs in Jamaica that my daughter was jumping off of this summer. But it wouldn't definitely be the lower levels that you'd be jumping off of. It'd be those high ones up there. So definitely pay attention to that if you're getting your health insurance on the exchange. So, all right, I think that's about it, Glennis.
All right, yes, I don't see any other questions right now. So thanks again, Tina. Lots of good information. And as she mentioned, she'll have the slides available on our CAP website along with the webinar. So if you need to go back and take a look, some of those that were skipped over, if you want to get any more details, the slides are generally available. So, all right. So thank you everyone for joining us today. Our recording of the webinar will be posted at cap.unl.edu, where you can also register for upcoming webinars. So you should see a short survey that appears as you close out of the webinar today, and we'd really appreciate that you take just a minute or two and give us some feedback. This really helps us plan ahead for future webinars. So again, thanks for joining us and happy tax season to everyone as we get into that. So take care. Thanks.